Hello, everybody. This is Professor Hassey. It's Business 6:30 weekend update for our first week of our summer session class in corporate finance. I'm speaking to you live and in color from my office in Claremont, California. Today's date is Sunday, June 11th, and I'm a little bit late with my weekend posting. I've been late all week, so I apologize to everybody for that. A couple things we're going to be doing in this weekend update is just refreshing your memory about the infrastructure of our class. You have a discussion post this week and a discussion post for next week that has now been put into your Blackboard. The discussion post this week is to tell us a little bit about yourselves in a bio, posting to create a folder in Blackboard, and secondly, to select a company that you'll be working with during the course of our 8 weeks. This company will be involved in case number 1, which is in a couple of weeks, and case number 3 towards the end of our course. So select a company of the Fortune 500 that you'd like to analyze and work on and use as a guide to learn more about corporate finance this summer session of 2023. And then we're going to talk a little bit about our topic this week, risk and return, and go over that a little bit more and as a good basis to leave into our second week of our course, which is going to be talking about the time value of money. So let's take a look at where we are with our course right now. Remember, we are on a discussion post right now. It's due this Sunday, today, June 11th. And then in the discussion forum, I have posted a schedule of dates available to you all to set up an appointment with me to come and talk to me individually in our student professor meetings for this coming week. So these two discussion posts and work for this first 2 weeks are worth 15% of your course grade. So please make sure you can complete them on a timely basis this week. Then next week, posted on Monday, June 19th, you'll have your first case. It's a credit analysis of the company that you select this week. And that will be posted on June 18th, due on June 25th. And in regards to that discussion forum, here it is right here. I have now, you have to complete, some of you have done it already, some have not. So I think we have one student who has yet to complete. So please post a bio of yourself and select the company. And then I wanted you to look at week 2 student professor Zoom meeting. As you can see, some students have already signed up. I'd like you to pick a day and time on either Monday, June 12th, Tuesday, June 13th, or Thursday, June 15th. Pick a time, create a form, and tell me what time you selected to make sure there's no conflicts in that time. And then I'll meet you all on our Zoom meeting. Here's the link right here, and also the link is in Blackboard. Just to talk about the course, get to know each other a little bit better, get a little bit more engaged with our course, what we want to do. And so please do that and sign up for that this weekend or early in the week so we can get together in the coming few days. Those are the tasks that you need to do for this coming weekend and week. Again, there's no case studies until another week from Monday. So none of that for this coming week. It's mainly getting up to speed and introduced to our course these first couple of weeks. Another thing I would like you to do this weekend is to read this Harvard Business Review article that I have in week 1 articles to review. Efficient, chaotic, what is the new finance? I'd like you to take the time this weekend to read this article because we're going to discuss it in our week 2 topics. Please take a gander at it. This is going to relate to your case number 1, which will be posted next week. And so I would like you to read this article and put it in your memory bank or highlight because we'll be looking and discussing this article later on in our course. So it's in your week 1 work. This article, you download it, Harvard Business Review, Efficient, Chaotic, What is the New Finance? Please take a look and read this article this weekend. One of the key topics of this first week, besides getting up to speed on the infrastructure of Blackboard, especially if you're a new user of the Blackboard platform, and also telling me a little bit about yourself, and also selecting a company to track or follow throughout our course, and finally to set a meeting time in the week 2 to meet with me and talk about the course individually, is risk and return. A key part of finance and investment is to understand the risk and its effects on return in corporate finance. Because if you have a high degree of risk, that means your chances of success are reduced. And as an investor, as a financial manager, to understand those risks are very important to strategic decision making in corporate finance. What is investment risk? Investment risk is exposure to the chance of earning less than expected. The greater the chance of a return far below the expected return, the greater risk. So let's say I want to go and invest in Apple Computer, and I expect a 20% return this year from Apple Computer, because I've read over the last 10 years, Apple historically has averaged 20 to 25% return a year. Historically, average is the key there. Lately, they have not been doing that. So if I go into 2023 expecting as an investor a 20% return on my Apple stock, that's going to be fairly risky. Why? Because the beta, or the historical review of those returns in the market, is rather high. Let's say 1.3 is the beta of Apple. In other words, the risk of accepting that 20% return is pretty great, because Apple has not been doing that over the last year or so. So your risk is very high. Now, as an investor, you have to go in with your eyes wide open. Yeah, it's one thing to say, I want a 20% return. It's another thing to say, what's going to happen if you don't get that return? Are you going to be upset, yell at somebody, sue somebody? No. Going into the investment because you realize or knew the high risk of that possibility of that return not happening, it's up to you to swallow that and accept it. So that's an important thing, especially in financial management. Understand the risk beforehand of an investment. And what are the chances of you getting a 20% return, or a 10% return, or a loss? What is that distribution of the likelihood of that's happening? And this goes back to our days of statistics and statistical studies of how you deviate from the average of the company to what is going to happen. It's called probability distribution. For example, in this probability distribution curve, if any of you are familiar with statistics analysis, here is a average, or here is some returns, the probabilities of those occurring at different levels. And for this company, the average, or the expected return, is 6%. That's the top of the curve. As the curve goes out, 10% return, 20% return, 30% return, notice the probability, or the distribution of that occurring, decreases from the expected of 6%. And the same the other way. Losses, negative 10% loss, negative 20% loss. So to understand the probability distribution of a return and the likelihood that it will happen, as the farther you get out in that curve, the greater the risk of that expected return is not going to happen. And that's what beta analysis is. The beta of a company is the likelihood that you'll match the average returns of the market. The average return of the market is an average, or a beta, of 1.0. And in this case, that would be 6%. And if you're expecting a 20% return off this company, that means, as you can see, the risk and the probability that will happen is severely decreasing. And that's what beta is. The beta is comparing the overall historical return of that particular company going out 4 to 5 years quarterly, compared to the return of the S&P or the 500 or the stock market. how you deviate from that average in the market. The market beta is 1. If any beta of your particular company is over 1, that means it has not as consistent of giving returns to match the market over the prior 4 or 5 years. That's a rolling average. Now, does that mean it's a bad investment? No, it just means it's not consistent with the market. It goes up and down. And if your beta is under 1, then you have outperformed the market in consistency. Your company has been even better and lower risk because it meets its goals and expectations of return every quarter. That's why the risk-free interest rate, the 10-year treasury yield, is a beta of 0. There's no risk. That is a guaranteed amount. It does not fluctuate with the market. Whereas if you invest in Apple Computer, that is not guaranteed that you'll get 20% return, even 6% return. It's not guaranteed. It's due to the performance of Apple Computer. So that's why the beta for corporations is significantly higher than 0, because 0, there's no risk. You know exactly what you're going to get when you invest in a 10-year treasury bond. And that's what we call risk. And as a financial manager, you have to be aware of your risk in your markets, because if you have a high risk, a high beta, a poor credit rating, it's going to be difficult to attract investors who are willing to take that risk. The only way they will take that risk is if you give them higher returns. And that means higher cost. So as that curve indicated, as you deviate from the expected or the average return of a stock, the standalone risk is that risk of each asset gets higher. Standard deviation measures the dispersion of possible outcomes. So in that curve, as you disperse out over a possible other types of return off that stock, the risk grows higher because it's deviating from the average, standard deviation. Investments with large deviations have more risk. High risk doesn't mean you should reject the investment, but you should know that the risk before investing. If you have a company with a high beta, doesn't mean it's going to lose money. It's just you need to be aware that the historical review of your company shows that they're very inconsistent in achieving their expected returns. And the only way you should stick with that company is if at the higher the risk, the company is going to try to get you a greater return to compensate you for that risk. So not to get too technical, but this is not a statistics class. I will never ask you to compare or find or calculate beta. You don't have to worry about that. Beta is a given number that you find from market analysis. But just an understanding of what beta is a key to understanding what beta plays in our investment analysis. Beta is what is considered the standard deviation of a portfolio of your particular stock, P1, to the market standard deviation divided by the standard deviation or the risk over the overall market. That formula gives you beta. And as I said earlier, the average of the market is 1. The average of risk-free for risk-free investments is 0. Your beta for whatever company that you have posted to the discussion forum, I ask you to find the beta. If your beta was over 1 for the company you selected, that means your company is not a poorly managed company, is not a loser. It's just that they have been a little bit more inconsistent in matching the returns on a quarter by quarter basis for their projected returns on investment by that company. That's all it measures. It measures the impact of your stock to the overall market standard deviation or market return over a period of time. So naturally, if you're going to invest in a stock in a company as an investor, or if you're a treasurer or a financial manager or a CFO of a corporation, you want to always know what your current risk is in the market so you can go out and attract investors. Even if you're not trying to issue any more stock, if you want to borrow money, financial institutions, banks, bond funds, pension funds all look at the risk of your company by beta. So even though you're not issuing equity, if you're going to borrow money, still risk is a key component to determine what investors will be willing to give you money for investment. And one of the standards or return for risk is called the risk-free interest rate. We've talked about that. It's the 10-year return on investment for a 10-year United States Treasury yield. Investors require a return for risk, which is the extra return above the risk-free rate that investors require to induce them to invest in stock. So if I'm going to invest in a 10-year Treasury yield, as of Friday, that was paying me roughly 3.3% return every year for that investment. But if I want to invest in Apple Computer, 3.3% ain't going to be right. I want a lot higher than that. The beta of Apple Computer measures the risk of me trying to go out and get the standard rate of return for Apple Computer, which currently is about 8.5%. The beta indicates whether that is risky or not. The higher over one, the greater the risk. Doesn't mean that Apple's not going to obtain that return. It just means the chances or the likelihood of it happening. And you as an investor should be aware of that. And you as a financial manager or a CFO have to understand that how can we make our company more attractive for capital is we want to reduce that beta over time of our company. How do you reduce beta? You make your company more attractive to returns, meaning less debt, meaning more profits, cash flow, and that's financial management. So it all kind of plays hand in hand in your return is company management and investor expected returns. And we talked about this in our Monday lecture. One of the key measurements of this required return and risk in the market is the capital asset pricing model. In other words, it's a measurement of the risk of your company stock compared to the market. The risk in the market is RPM, the market premium, which is the current return of the market, the overall stock market, usually measured by the Standard & Poor's 500 return, minus the risk-free rate. And you take that market premium, the market return minus the risk-free rate, and multiply it times the current risk of your particular stocks, beta I. So if your company you looked up in your discussion forum this week had a beta of 1.22, you can determine the expected return based on the current market risk of that company today by comparing that, taking that beta and multiplying it times the risk-free rate minus the market premium and get that market return rate, and you can determine the risk in the market. And this is one of the things you'll be doing in your case number one when you take a look at the credit and the risk of your particular companies that you selected in week one. What that means is you're going to take the required return is going to equal the risk-free interest rate plus that market premium we just talked about times the beta of your company. That entire formula equals the expected return of your investment, your company in today's market. The risk-free interest rate plus the market premium times the risk or the beta of your company. So naturally, the higher the beta, the greater the risk and the return. The lower the beta, the lower the risk and required return. Another concept of this capital asset pricing model is another way of saying it is the cost of equity. It's the cost of equity, what your company needs to provide as a return on the stock investment in your business. Capital asset pricing model equals cost of equity equals expected return based on the risk of your company in the market. Okay, let's look at a real example of determining this capital asset pricing model, the cost of equity or the required expected return. Let's take a company, and I'm going to select General Electric. So I'm going to type in here, General Electric. I am Yahoo Finance, which I feel is the most easiest user-friendly way of getting any financial data. It's not 100% accurate, but it's a quick and easy way of getting financial information about any publicly traded company in the market. So I'm going to type in General Electric, and here it is right here, and I'm going to bring up General Electric. And this is a summary schedule, which gives the closing stock price last Friday of the company. But more important, it gives a lot of financial information. And here's one that I'm in particular interest of. It's the beta of General Electric. The beta is a 5-year monthly average over time, over 5 years of the risk of General Electric to the market. Remember, the market is 1.0. So beta of General Electric currently is 1.19, which means it's a little bit more riskier than the market. Okay, now that I know the beta is 1.19, what is the market risk or required return of General Electric today in the market? So we'll go to a spreadsheet, and let's type in General Electric beta currently is 1.19. Okay, the current risk-free interest rate as of the close of business today, Friday, the closing 10-year Treasury yield was roughly about 3.45%. Okay, that's a beta, or that's a beta equaling 0. The current S&P 500 market return is currently 9.15%. That's with a beta of 1. All right. What is General Electric's expected return? Or, another word, cost of equity. All right. Well, let's do the capital asset pricing model, which equals the expected return, or R, is equal to the risk-free interest rate plus the market premium, which is the market rate minus the risk-free rate, and that number is multiplied times the beta of General Electric. All right, let's do the math. So the risk-free rate is currently 3.45%. We're going to add that to the market premium, which is 9.15% minus the risk-free rate of 3.45%. And that number is going to be multiplied by the beta of General Electric, which is 1.19. All right, so let's do the arithmetic. First of all, let's do the market premium. If we take 9.25 and minus 3.45, what do we get? Let's make that a decimal. We get 6%. 9, that's not right. 9.25 minus 3.45. I typed it in wrong. There we go, 5.8%. Okay, so we're now going to do equals 3.45 times 5.80 times 1.19. And that's incorrect. I did the formula wrong. Let's do that again. Should have done this beforehand. I was short a parentheses, 3.45 plus, plus parentheses, 9.25 minus 3.45 another parentheses times 1.19. That should work. Be nice if I put an equal sign there. Oops, now what did I do? Okay, I'm dealing with a newer version of Excel here, and I wasn't used to the formula. So here we go. Let's try this again. So the expected return is the risk-free rate 3.45 plus parentheses the market premium, which we calculate as 5.80 times the beta of GE 1.19, put that in parentheses, and we get 10.352%. That's the expected return based on the risk of General Electric that an investor would want today if they would invest in General Electric stock. They would expect in the next year to get a 10.352% return. Does that mean they're going to get it? Who knows? It's up to General Electric and it's up to the market. But based on zero risk, average risk, and the risk of the company, an investor should expect to get a 10.352%. Now, if an investor Monday morning calls their broker and says, do you think General Electric's going to get to 10.352% return in the next year? And the broker says, I don't think so, they won't buy. But if you take a look at the financials and the expectations, remember, every public corporation in America has to disclose every quarter their expected earnings for the next 12 months. So if General Electric in their expectations say, yeah, I think we can make 11% next year, well, then people might be attracted based on the risk in the market of General Electric to buy that stock. If they don't think they're going to make those returns, they won't buy. If they already own the stock and they don't think those returns are going to be met, they'll sell the stock. If they want to buy more of the stock because they expect the returns to be there and General Electric will achieve them, they'll buy more of the stock. Welcome to the stock market. But the risk is the key measurement here. The risk of the beta of General Electric, which is 1.19, compared to the market risk of 1.0 and the risk-free rate of 0. So if I am definitely afraid of losing money, I'm going to buy the United States Treasury note with zero risk. I will not lose anything, but I only get 3.45%. If I want average risk, I'll invest in the stock market and get 9.15%. But if I want General Electric risk, I have to pay. I assume that risk. I want to expect to get more of return. I'll get 10.352%. And that's the key to understanding risk in the market and how those strategies of running your company, finding the assets to invest to make sure those returns come forward into the future. It's all about financial management and corporate strategy. Okay, so there's an introduction and a review of our risk and return topic for this first week, and we'll use that as a basis of doing our case number 1 as described, and we'll talk more about that as we get into week 2 topics, which is going to be concerning about the time value of money and a debt investment or debt capital fundraising to borrow money to purchase assets. That's our topic for this second week, and there'll be a video posted on Monday, June 12th for that week. So please get up to speed on your discussion posts, and I look forward to working with you again next week and talking to you in our student professor meetings in week 2. Thanks, everybody. Have a great rest of the weekend. Until next time, adios.